How is the world shaping up with this fall in crude prices? What is it telling us? To give us both a global and an India perspective, Taimur Baig, Chief Economist Asia at Deutsche Bank, joins us now. Good morning, Taimur. Good to have you with us, and a very happy New Year to you. How should one understand the seminal fall in crude prices? Is this going to be a year of lower global growth than last year? Or is crude alone in a picture of its own?
Happy New Year, Lata. It's a mixed bag. Of course, lower crude prices is a great windfall for all commodity importing economies. And the wealthier the economy, the bigger the impact. So if you look at the US or even the Japanese consumers' wallets, the pump price decline immediately translates into a pickup in discretionary expenditure elsewhere. For not so wealthy economies, and I have basically developing countries in Asia in mind, the impact is more dramatic on the macro side than on the consumer pocketbook side. It's not likely that the Indian consumer, on average, is going to go out and spend a lot of money just because petrol prices have fallen, because the petrol or diesel prices or items don't make up a very large part of their consumer index. As you can see in the CPI of India, for example, it doesn't even show up in the transportation index. It's under miscellaneous. So a big impact on consumer demand or a big impact on company profitability, we'll have to see how it transpires in the developing part of the world. In the advanced economies, it's a very big plus. But your broader question, which is, what does it mean for overall global outlook, it's mixed, because you will see quite a bit of collateral damage among the commodity-producing economies. And far more importantly, I think we should realize that it's not just a supply-driven phenomenon that is causing this decline in commodity prices. There is a big demand component stemming from China, where week after week we are getting more and more worrisome data about that outlook. We ourselves now see Q1 in China being sub 7%. So the biggest source of demand for the whole world for the last 2 decades has been China, and that's weakening, and that can be a very good news, even if low oil prices are good news.
Okay. Taimur, hi, good morning and Happy New Year to you. So let's do some number crunching then. How much will the fuel bill go down by because of the big fall that we've seen in crude, and how much will it really aid the twin deficits?
Right. So in the case of India, mind you that fuel subsidies, we have talked about it ad nauseum for many years, but they don't really make up that big a part of the budget. The overall total energy subsidy bill for India used to be 0.91% of GDP. After the diesel price and petrol price reform that began in 2013 with the previous government, by the time we came along to 2014-2015 fiscal year, we were looking at no more than 0.6% of GDP, and that is long before this fuel price decline came in. So we're starting with a low base. It's not an area where you can have very large savings. We think the best we can see for this fiscal year is about 0.2% of GDP, so instead of 0.6, get about 0.4 in the overall energy subsidy bill for this fiscal year. For next fiscal year, maybe another 0.1, 0.2%, because as you head towards zero, you can't really go much lower. You still have LPG subsidies, you still have some degree of kerosene subsidies. So the scope for saving is not very large. Import bill, of course, will fall, and there is a very big impact on the current account, but the fiscal impact is not that large.
Okay, then for these and other reasons, trace out the inflation trajectory for us, Taimur. You pointed out that in any case, crude is not a very, fuel is not a very big part of the consumption basket. How do you see the CPI, therefore, trending this year?
Right. So when we look at historical data, whether it is WPI or CPI, historically speaking, the fluctuation in fuel prices haven't had very broad impact on second-round effects. You don't see, transportation prices going up exactly in line with fuel prices, and hence I don't see transportation prices going down substantially with the decline in fuel prices either. So now the December inflation data, of course, is the one that we need to focus on, where we have an adverse base effect, and we will see inflation rebound. Will it rebound to 6%? Unlikely, given the ceiling that is being imposed by weak commodity prices. So I think more like a 5.5% print for December, and something like that even for January, February. Mind you, the other big relief that comes on the CPI, WPI side at this time of the year is from food. Seasonally, these are good months for food, but I think we have sort of advanced that correction already in November, December, after the spike that we saw in August, September. So the likelihood of major further decline in food prices is unlikely. We actually follow food prices on a daily basis, and the last 2-3 weeks data don't suggest any further downside to food anyway.
So, no, what's the number therefore? I mean, are you looking at a sub-6 number by March 31? What will be the December number itself, January, if you have?
Right. So December, as I said, 5.5%, and perhaps again 5.5% for January. Now, what happens in February, March? Probably, you know, some of the adverse base effect will start fading, and we could head toward low fives. But we'll have to see what happens with food prices, because that sort of implies or assumes huge seasonality, very favorable seasonality on the food side, which in my view may not be the case this year, because we've already seen the food price correction. So this mid-5 to low-5 inflation is where we will be for the next 2-3 months, unless, of course, we see further dramatic decline in global fuel prices, and that leads to knock-on domestic declines.
So what are the guesses on rate cuts from the Reserve Bank, the timetable and the numbers?
Right. I think that, you know, we haven't talked about fiscal other than the fuel subsidy issue, but I think fiscal is a source of great deal of concern to us. And I think beginning from last month, we started seeing the Minister of Finance also start echoing some of our concerns. So I think RBI also sees exactly the same situation. There is some uncertainty on the revenue side. There is some uncertainty about what is happening with the deficit and what the government will do with respect to its deficit target. So I think if I were in the RBI shoes, I would wait till the budget, which of course pushes the first rate cut in this cycle to March.
In fact, that was my next question, Taimur, because, you know, there's a lot of optimism in the North Bloc with respect to the fiscal deficit target being met. That's perhaps because there are expectations that revenues from the spectrum auction will be higher this time around. What is your own estimate of whether that 4.1% number will be met, and how much could come in from the auctions?
Look, the authorities can make 4.1 in an official document, no doubt about that. We saw the similar sort of heroic numbers in the last year's budget as well. But that would be a poor quality number, in the sense that it would be a function of arrears, postponed expenditures, and of course, huge amount of cutback on planned spending. So I don't have a very strong view on how much money can be raised on the spectrum auction, but I do have a great deal of concern about the 0.6% of GDP worth of disinvestment revenue that the authorities have in mind. And we're already almost halfway through January, basically 10 weeks left in the fiscal year, and nothing has been raised so far. And of course, if you think about the crown jewels that the authorities want to disinvest, they're all commodity related. So the timing could not have been worse. Unless, of course, you know, you have domestic players basically picking up, LIC, for example, picking up the shares of Coal India or something like that. Any case, these are poor quality adjustments. We see disinvestment at one-off that should not be considered as a part of a sustainable improvement in fiscal. And cutback in planned spending, as the Chief Economic Advisor pointed out, that's negative for the growth. So that is also not a very good way of achieving the 4.1. But the short answer, they will achieve it if they want to.
Okay. Taimur, sorry to come back like a broken record to the same theme. What's the inflation trajectory for FY16? Do you think we remain at 6% as Reserve Bank had forecast, or we will get a slightly lower number? And therefore, for all of 2015 calendar, what are the likely rate cuts?
Right. I think we should all be very humble about the inflation forecast of India. As we saw in last year, how, you know, when we were dovish, it went up, and by we I mean the RBI and the analyst community, and then we got very, very worried, it came down. So we should add a great deal of sort of confidence interval around any inflation forecast for 2016 and 2015-2016. If food prices remain well-behaved and fuel continues to trend downward, we can hang around in the 5.5%, if not 4.5% to 5.5% for the rest of the year. No doubt in my mind. And that would, of course, mean the glide path of RBI is very much in place. And if some sort of a legal framework is provided to the RBI, it can actually credibly announce a 4% plus minus 1 or plus minus 2 sort of a target. Whether that happens, I think it's beyond economics or inflation forecast. I think the central government will have to weigh in very heavily on that issue, but that's probably a subject for another day.
Okay. All right, Taimur, we leave it at that. Thanks for joining us and giving us some realistic expectations that one can have from this government.